Okay, let's unpack this. We're taking a deep dive into the world of travel and lifestyle services aggregation today, specifically zooming in on one key player, looking at their recent performance, their big strategic shifts, and what they see coming next.
That's right. We've gone through the source material you sent over the latest financials, some strategy docs, and the full earnings call transcript, really trying to pull out the most important insights for you.
Yeah, our mission here is to cut through all the data, all the talk, and help you understand what's really driving this company's business right now. And they're pretty ambitious plans for growth, especially, with the travel landscape changing so much. So who are we actually talking about? The company is Dreamfolks Services Ltd. And based on the sources, they clearly position themselves as, well, India's leading aggregator in this travel and lifestyle space.
Exactly. Their model, it's built around their own in-house tech platform. You can think of it like a central hub connecting their clients.
Big names, right? Banks,
Hmm.
airlines.
Yeah, banks, card networks, airlines, OTAs, even other large companies, connecting them with a whole network of different service providers.
Got it. So they're not like running the lounge themselves. They're the connection point,
Yeah,
and it's fundamentally B2B to C.
precisely. They provide the services for their clients and customers, so enabling those customized perks and benefits you might get, maybe through your credit card or a frequent flyer program.
Okay. So looking at the recent numbers then, the year ended March 31, 2025, FY25. What did the top line look like?
Well, the top line numbers were interesting. Revenue from operations hit about INR 12,919 million on a consolidated basis.
That sounds pretty significant. What kind of growth is that?
It is, and it represents roughly 14% growth compared to the previous year, FY24. Now, what's really interesting, and the sources flag this, is that this 14% growth actually outpaced.
Outpaced the market.
Yeah, it outpaced the growth in domestic air passenger traffic and also the number of new credit cards issued in India during that time. Both of those were growing around, say, 7.5% to 8%.
Wow. Okay. So growing faster than those key drivers. That suggests they're either, getting deeper into the market or getting more value per user. How did profitability hold up with that growth?
Profitability margins actually came in within the guidance they'd given.
Yeah.
Gross profit margin was 11.6%, which is right in that 11% to 13% range they talked about.
Okay.
And adjusted EBITDA margin was 7.9%, also within their 7% to 9% guided range.
Right. So hitting the margin targets. But I think I saw the bottom line, the net profit, PAT, that was down a bit year over year.
That's correct, yeah. Consolidated PAT for FY25 was around INR 651 million. That's a slight dip from the INR 686 million in FY24. And basic EPS also went down slightly, from about 13.02 to 12.32 rupees.
Okay. And what about the underlying financial health? Balance sheet, cash.
Balance sheet looks strong. Net worth grew quite a bit, up to INR 3,006 million by the end of FY25 from about 2,364 million.
Healthy increase.
Yeah. And cash equivalents, including their investments, were also healthy at around INR 1,480 million. That's up nicely from INR 1,010 million the year before. Plus, they saw a pretty significant jump in cash flow from operations.
Good. And just to tick the box, the auditors gave a clean opinion, right?
Oh,
Unmodified.
Yes, unmodified opinion on the FY25 financials. So the numbers are presented fairly.
Okay. Now, you mentioned that slight dip in PAT. To understand that, we probably need to talk about a key challenge they flagged, didn't they? This spend-based shift.
Exactly. That came up quite a bit. This is the move by many banks where, instead of just getting automatic lounge access with your card.
Right. Now you often have to hit a minimum spend target first.
Precisely. And the company was clear this had a, quote, short-term implication on their growth and margins over the past year. And crucially, it seems to be a key reason why their overall lounge volumes were kind of flat in FY25.
Even though air travel itself was growing.
Exactly, despite that underlying passenger growth we just talked about.
Okay, so that connects the dots. It explains some of that pressure on PT and why margins didn't necessarily expand much despite the revenue growth. Sounds like navigating that shift was a major focus.
It definitely was. And, responding to challenges like that is clearly feeding into their new 5-year strategy. They've laid out a very clear vision now.
And it sounds pretty ambitious. I saw they have an aspiration to actually double their revenue in the next 4 to 5 years.
Double the top line, yes, that's the goal. And alongside that, they're aiming for profitability margins to see a substantial increase over this period.
Wow. Doubling revenue and substantially boosting margins. That's quite aggressive. How are they planning to pull that off, especially when A core service like lounge access has faced these headwinds.
Well, that's the core of the strategy, right? It involves, sure, consolidating their existing lounge services. They're still important, but the really big push, the emphasis, is on exponentially adding other new services.
Exponentially. That sounds like they mean business, more than just adding one or two things.
Definitely. They even put a number on it. The target for diversification is to scale up the contribution from these other new services to one-third. One-third of total revenues within the next 5 years.
A third. Up from, what, about 7% in FY25? Wow. Okay, that's not just tweaking the model. That's fundamentally shifting the balance of the business.
Absolutely. This isn't a minor adjustment. It feels like a core strategic pivot. And the plan is to get there by really focusing on and prioritizing diversification across a whole range of what they call high potential services things, well beyond just the airport lounge.
Okay, so let's unpack these other services, because the list mentioned in the sources is pretty diverse. Things like highway dining, pay-and-use models, access to social clubs.
Coffee at malls, baggage wrapping, excess baggage services.
Yeah, and they've been adding others too, right? Like meet and assist,
Yeah.
more global lounges.
Need and assist now at over 400 airports globally. They've added over 300 global lounges, brought on multiple new airport food and beverage outlets, both domestic and international. They even acquired a company for golf service.
Golf.
Yeah, covering domestic and global clubs. And they mentioned making a foray into the railway sector, too.
That's a massive spectrum.
Yeah.
How do they actually aggregate some of the maybe less obvious ones, like highway dining or baggage wrapping? How does that work on their platform?
Yeah, good question. So for something like highway dining, it seems to work similarly to the lounge model. They partner with specific restaurant chains or outlets located on highways, integrate them into their network.
Okay.
So you as a customer might use your linked card or app to get, say, a discount or maybe a complimentary item at one of these places, all facilitated through the Dreamfolks platform.
Right.
And for baggage services, they partner with the providers at the airport. So you could book wrapping or handle excess baggage fees via the platform, often positioned as a premium service linked to certain cards or maybe part of the pay and use. It's all about building that network and making it seamless through the tech.
Yeah, that makes sense. Applying the core aggregation model to new areas. Now, why prioritize something that seems, well, relatively low ticket like coffee at malls? What's the strategy there?
Well, that seems quite strategic, actually. Coffee at malls is a lower cost benefit for banks to offer, right? So it lets them provide some kind of perk to a much wider customer base.
People who maybe don't hit those high spend targets for lounge access.
Exactly. Plus, it expands Dreamfolks' footprint beyond just airports. Gets them into Tier 2, Tier 3 cities, reaching customers where they are more often. It sort of positions them for more sustainable, broader engagement, not just tied to air travel.
Okay, interesting. And the access to social clubs. That sounds like it's aimed at a different level entirely.
Oh, definitely. That's clearly targeting the premium lifestyle segment, offering access to, I think it was over 3,000 members-only premium clubs worldwide. That adds a real luxury element alongside the travel stuff.
And what about this pay-and-use model? How does that fit alongside the benefits funded by the banks?
So this is quite interesting for, you as a potential customer. The pay-and-use model lets customers directly buy access to the entire portfolio of Dreamfolks services.
Not just lounges.
Not just lounges, potentially anything in their network. Often, it seems, through the bank's own app or website, maybe with some negotiated discount. So it creates another revenue stream for Dreamfolks and the bank.
Right.
And it enhances the value even for customers who don't qualify for the free stuff, but still want the convenience or a better price than walk-up.
So it opens up another channel. And it's not just about consumers using cards, right? They specifically mentioned adding enterprise clients as a key part of this growth strategy, moving beyond just banks and card networks.
Exactly. That was highlighted. They're actively targeting large enterprises now, potentially offering these services for their employees as perks or maybe for the enterprise's own customers. They even mentioned adding some big names like Make My Trip and Amazon as clients.
Wow. Okay. That really broadens their potential market beyond just financial services.
Significantly.
Now, all this scaling, this diversification, it sounds like it absolutely hinges on their technology platform.
Oh, completely. Their proprietary tech is foundational. The sources really emphasize it's built with, top-tier security, reliability, holds key industry certifications. What that means practically is a platform designed for huge scale.
Handling millions of transactions.
Millions of transactions across all these diverse services. It allows for customized solutions for different clients, enables real-time interactions between everyone. It gives them agility.
So it's much more than just a database. It's the engine making it all work together.
Precisely. It helps their clients, say, increase ancillary revenue. It acts as a key differentiator for a bank or airline trying to win your business. The platform's job is to deliver these tailored service packages efficiently and, ideally, provide a really smooth, frictionless experience for you when you actually go to use a benefit.
And alongside the tech, they're also expanding their physical footprint, right?
Yes, complementing the tech. They mentioned adding over 100 new lounges and F&B outlets globally through partnerships, like one with Plaza Premium. Domestically, they fly to having 100% coverage of airport lounges where they operate, and they're expanding into railway lounges, too.
Okay.
This physical presence tied into the tech is really key for ensuring that the service you get is consistent and high quality.
Now, why this huge push for diversification now? What's happening in the broader market that supports this kind of move?
Well, they pointed to some really strong industry tailwinds. I mean, India's travel industry is just booming. It's expected to grow significantly,
Guys, that's
somewhere between 12% and 15% annually for the next 5 years, according to the forecasts they cited.
That's huge growth. Broken down, was it different for domestic versus international?
Yeah, domestic travel forecasts at 12–13% annual growth, but international travel from India even higher, 18% to 20% annually. They also noted visa applications from India were up 11% just last year alone.
Wow.
And this growth isn't just numbers, right? It reflects changing attitudes. Travel is increasingly seen, they suggest, as a key part of, well, personal well-being, seeking experiences, not just getting from A to B.
And I guess the explosion in credit card spending plays a big role, too.
Oh, absolutely. Credit card spending in India hit a record high, over INR 21 lakh crore in FY25. That's like 15% growth. This surge, especially among the kind of people who use these travel and lifestyle perks, directly fuels demand for exactly the types of services Dreamfolks is pulling together.
So, okay, these strong market conditions, fast travel growth, changing consumer views, massive credit card spending at all, creates a really supportive backdrop for Dreamfolks' strategy, especially this big, aggressive diversification plan.
Yeah, it seems well timed. Now, just pivoting quickly to a few specific points that came up in the earnings call Q&A, some financial details worth clarifying. For instance, someone asked about an increase in finance costs in the last quarter, Q4 FY25.
Right, that might look a bit odd on the surface.
Yeah. The company clarified this was mainly a provision they made for potential delay payments based on certain contract clauses they have. And these are apparently still under discussion with vendors. So, crucially, they stressed it's not necessarily an actual cost they've incurred yet, just an accounting provision for now.
Okay, that makes sense. And what about the increase in lease liabilities we saw on the balance sheet?
That was simpler. They attributed it to moving into a new, larger office space. Accounting standards, like in AS 116, mean when you take on a big new lease like that, you have to recognize a higher lease liability and a corresponding right-of-use asset on your balance sheet.
Got it, standard accounting for a new lease. What about other income? Any color on that?
Yeah, they mentioned it included things like profits they made from redeeming some mutual fund investments and also some foreign exchange gains.
Okay, one other expense line that saw a noticeable jump was employee benefit expenses. What was the story there?
Yes, they tackled that head on. They basically said this was a deliberate investment. They've been expanding their skilled employee base quite significantly.
Why? For future growth.
Exactly. The stated goal is to build the capacity they need specifically for these future growth areas, things like the global expansion, handling those new enterprise clients, and actually onboarding and managing all these new services we've been talking about.
So investing ahead of the curve rather than just reacting to current business levels.
Precisely. They acknowledged it takes time, maybe 1 to 4 years for these new hires to fully ramp up and really contribute to the bottom line in a big way. But they expect to see that contribution within that medium-term 4 to 5 year strategy window. They also hinted that the rate of increase in employee costs might moderate a bit in the immediate next year.
Okay. Thinking about the competitive side,
Yeah.
how do they describe their relationships with their key banking partners? And how do they view competition in general?
They described the relationships with banking partners as very strong, especially, they said, with the top 10 banks where they're deeply integrated. And they made a point of saying they typically work across the entire portfolio for a client. meaning all their different credit cards, debit cards, not just one specific card variant. That deep integration across the whole product range sounds like a key strength or a barrier to entry, perhaps.
Right. And in terms of winning business against competitors.
They framed acquiring clients from competitors as a clear advantage and opportunity. And interestingly, they noted that some banks actually migrated over to Dreamfolks before a specific competitor apparently ran into some contract issues, which mainly affected domestic lounge access.
So they weren't just picking up business due to competitor problems, they were actively winning clients beforehand, too.
That seems to be the implication, yeah. That they were winning on merit or proposition even before any disruption elsewhere.
And just briefly, what about the global expansion efforts? How far along are they?
They mentioned they kicked that off about 2 years ago. They now have a network presence across 120 countries. Southeast Asia seems to be a key focus area, and they've actually set up a subsidiary and a local team based in Singapore to drive that international growth.
Okay, wow. That was a really comprehensive deep dive into what's going on with the company.
Yeah, I mean, we've seen how they're actively responding to some recent industry shifts, like that spend-based model hitting lounge volumes, but also how they're trying to align with these massive market growth opportunities. It really feels like a strategic pivot, moving well beyond being primarily just a lounge aggregator
Right.
to becoming a much broader platform for travel and lifestyle services.
Yeah, the key takeaway really seems to be this bold plan. Dramatically increasing revenue from all these new services, aiming for that 1/3 of total revenue with the big goal of doubling overall revenue and substantially improving margins in the next 4 to 5 years.
And it looks like that ambitious strategy is underpinned by, well, their proprietary tech platform, which seems crucial. They're expanding operational reach both here and abroad, and definitely those powerful market tailwinds in Indian travel and spending.
So thinking about how much companies rely on perks and loyalty programs these days,
Mm-hmm.
to attract and keep as customers across everything, credit cards, airlines, even retailers.
Yeah.
It makes you wonder, how might this kind of aggregation, pulling together such a diverse range of travel and lifestyle services onto one platform, how might that fundamentally change the way you choose which financial products or travel providers or even other companies you engage with in the future? Definitely gives you something to think about.